Good morning and welcome to Charting the Markets on Monday, the 27th of March 2023. Ongoing deposit flight from banks will lead to a major contraction in lending activity, which could push the US economy into a recession. And because of this, last week we saw a lot of volatility in equity markets, not just in the US, but also in Asia and in Europe. Now, we saw the culmination of further banking crisis fears push Deutsche Bank, Germany's largest bank's shares down by over 8% on Friday, before equity markets recovered somewhat in the US session. Now, if you look at the Asian session this morning, it was rather mixed because on the one hand, we had the International Monetary Fund's head, Kristalina Georgieva, who said that China is showing signs of a robust economic recovery. But at the same time, we also had industrial production profits out from China for January and February, and these dropped by 22.9% year on year. So let's just have a look at what the European markets did with regards to the follow-through with regards to Asia. And we can see on the daily financial bet here of the FTSE 100 that we opened up slightly higher than we closed at on Friday, but then faltered around this short-term 3-week downtrend line and are currently trading marginally above 200-day simple moving average here in red at 7,431. Now, this is kind of interesting because the 200-day simple moving average, even for investors who trade the markets from a fundamental point of view and don't really look at charts, it is still something they might be aware of. And the idea is that if you trade above the 200-day simple moving average, which approximates a year's trading data, then the underlying asset's supposed to be bullish. And if you trade below it, it may be bearish. So what's happened here is basically we've been trading around the 200-day simple moving average since mid-March and have had days where we closed above it. And now we actually dipped below it last week, but we didn't close below it. So this gives still hope to the traders who are long the FTSE 100. And from my point of view, because we formed this hammer formation on Friday, I would also expect further upside to be seen this week as financial markets may calm down, and provided we do not have a daily chart close below Friday's low at 7,331. So as long as that level holds, we may well break through the downtrend and then retest the highs seen on the 22nd of March at 7,587, a rise above which would then take us back up again towards the previous support area, now resistance area, seen between the mid and late January lows between 7,708 and 7,724. So we'll have to see what happens with regards to the FTSE 100, whether we can break through this downtrend line in the next couple of days or so. If we were to fall through 7,331, Friday's low, that is, on a daily chart closing basis, then the floodgates are probably open for us to not only just fall through the low at 7,204 that we saw earlier in the month, but also probably all the way back down again towards the October low at 6,705. But as I say, personally, I expect, because of the chart picture that I'm seeing at the moment, further upside to be seen in the course of this week. In Germany, what has happened here is that we've had a very nice bounce off the low seen on the 20th of March at 14,459, rallied all the way back up again to 15,304. But as you can see here, we faltered in this major resistance area made up of the February lows, really. And earlier today, we did open up slightly higher. We also had the German Ifo Business Climate Index for March out, which came in at a better than expected 93.9, because it was expected to come in at 91.0, and in February it hit 91.1. So 93.3 is actually a bit better. Business climate in Germany seeming to pick up. And we'll have to see whether we can break through this 3-week downtrend line. And if we were to close above it today, I believe the 15,304 high seen last week will also be attacked and probably broken through in the course of this week, with the highs seen since February between 15,656 and 15,709 once again being targeted. So this is the scenario provided we can stay on a daily closing basis above the last reaction low, and the reaction low, as we probably all know now, is basically a low on your candle or bar chart, which is lower than the low compared to the previous candle and to the following candle. So you can see this low here is lower than the one to the left and to the right. So as long as we stay below above 14,801, above this hammer formation low, further upside, in my opinion, is likely to be seen. Were we to fall through 14,801, we would then probably also fall all the way back down again towards the current March low at 14,459, and probably head all the way back down again towards the red line here, which is the 200-day simply moving average at 13,897, and also the December low at 13,697. But as I said, provided 14,801 holds, the bulls could still push the market higher over the next few days. In the US, the picture is quite similar with regards to the Nasdaq 100, which has been outperforming its peers to a large degree, looking very bullish indeed, because last week we actually made briefly a 7-month high on the Nasdaq 100, as investors seem to go out and sell their banking stocks and into tech stocks. And you can see here, whereas the FTSE and the DAX had some big down days last week, the Nasdaq 100 didn't, and just continues to grind higher. So in regards to this short-term uptrend we've seen since mid-March, I expect now to see a break of not just the September high, but also the February and current March highs between 12,902, 12,947 to soon take place, and to then take the Nasdaq 100 all the way back up again towards the August high at 13,722. So this is the most probable scenario. And if we were to see a reversal to the downside, and if Friday's low at 12,601 were to be fallen through on a daily chart closing basis, then we would also have pretty good support at the early March high at 12,467. So for me, technically speaking, as long as we remain above the 20th of March low at 12,398 here, the trend that we've seen over the last couple of weeks, the uptrend, still very much remains intact. Now, last week's worries with regards to the ongoing banking crisis basically led to a lot of volatility with regards to currencies as well, especially the US dollar, because as banking stocks were sold off quite heavily in Europe, the US dollar benefited with flows out of the euro going into a safe haven currency such as the US dollar. And we can see this on the daily euro dollar financial bed chart here, where we rallied to 109.29 last week, but then came off for the last few days as the worries to do with the Deutsche Bank, Germany's largest bank, perhaps going down a similar route as Credit Suisse pushed Deutsche Bank's share price down by over 8% on the day. But the bank is actually quite solid, and perhaps this week's market players might agree with that point of view and buy its shares again. Thereby, we could see some stabilization with regards to the banking sector, which may then lead to flows out of the US dollar, pushing euro dollar back up again. As you can see here on the daily financial bed, we're just holding above this tentative uptrend line. We tested it earlier today around 107.40, held above it, and there's not much going on here really, as the market is probably waiting for Friday's PCE inflation data, which is the inflation data that is preferred by the US Fed and may give us an indication what the Fed is likely to do. Having said all that, the market participants last week, because of the tightening of lending activity seen because of the banking crisis and the fears of a recession, many more analysts now expect the Fed to already have reached its pivot and to perhaps also be starting to cut rates earlier than anticipated and do so already this year instead of next year. So all of that will have an impact on the US dollar. And for me, technically speaking, as long as euro dollar remains above Friday's low at 107.14, we could see the currency pair retest the 108.04 mid-February high. A rise above there would then take us back up above the current March high at 109.29 towards the 110 area. If we were to fall through last Friday's low at 107.14, however, we could then retest the breached downtrend line, which because of inverse polarity now becomes a support line at around 106.84, and that ties in more or less with the early March highs where we see some pretty good support. But short term, I expect further upside to be seen with regards to euro dollar. Now, this can't be said for euro sterling because, as you can see on this chart here, euro sterling has actually come off its high from last week, 88.65, and continues to do so. So I expect further weakness to take the currency pair down towards the late February low at 87.55, and then all the way back down again towards the 87.22 to 19 lows. And these are the January and current March lows. So further downside, as long as we stay below 88.65, is to be expected to be seen with regards to euro sterling. And with regards to cable, so the British pound against the US dollar, we can see here that we've seen a nice uptrend over the last few weeks, probably because the Bank of England might not have reached its pivot yet, whereas the US is now definitely expected to have reached its pivot. And that means we could see further upside with regards to the British pound versus US dollar. Right now, we're holding at this tentative support line. We're also holding above the low seen on Friday at 121.91. As long as that holds on a daily chart closing basis, further upside is likely to be seen to take us, first of all, above the mid-February high at 122.70, and then also above the 123.43 high seen last week. And that could then take us all the way back up again towards the highs seen between December and January. And these were made at 124.46 to 48. So probably further upside to be seen with regards to cable, provided we stay on a daily chart closing basis above 121.91. Commodity markets have also been affected by the volatility surrounding the US dollar, and we can see, for example, the price of Brent crude oil. That has come off quite sharply because of these increasing recession fears, and then last week bounced off its low seen, the one-year low at $70.09, rallied all the way up to Thursday's high at $77.14 before coming off again. Now, if the muted risk-on sentiment we are seeing today in equity markets continues, I wouldn't be surprised that if the price of Brent crude oil were also to gradually head back up again, and if it were to rise above Thursday's high at $77.14, then it will probably once again retest the January and February lows between $77.65 and $79.04. And that acts as quite a good resistance area. So I wouldn't be surprised if we were to stall in that zone over the next few days. But short term, the $70.09 March low is likely to hold in the days ahead. Now, the main beneficiary of the banking crisis was gold. As we can see here, the price of gold rallied by over $200 from its late February lows, rose all the way back up to a one-year high at $2,009 per troy ounce, but then came off again and retested the psychological $2,000 mark last week, but that failed there. And if risk off sentiment, as seems to be the case today, abates, I wouldn't be surprised if the price of gold were to fall back and retest last week's low around $1,935 per troy ounce. Failure there could lead to the price of gold drifting back down again to below the $1,900 mark. Now, last but not least, let's have a quick look at copper, because the price of copper is also in a way reflecting what market participants think of the economy in general. And it has bounced off its March low at $8,443 per metric ton, has risen all the way up to Friday's high at $9,094, but then came off again and is currently trading below this breached downtrend line, which is supposed to act as a support line because of inverse polarity. But if we were to close below it today, then it looks quite likely that we might retest the mid-February low, which comes in at $8,787. And below there, we've got quite a lot of support coming in around the February low at $8,671. So perhaps further short-term downside to be seen with regards to the price of copper. And for the bulls to be back in control, we need to rise and close above $9,094, in which case we could retest the February high at $9,212. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.